results review of the U.S. initial jobless claims. The initial jobless claims number came in at 29,000 better than what was anticipated. 29,000 less people than were forecasted applied for unemployment benefits in the United States. We're looking at the U.S. dollar chart, and here at the release at 8:30 we will note that the U.S. dollar reacted positively for a very short period of time on that release. And the trade plan is a reversal of this U.S. dollar movement, which means we're going to sell the U.S. dollar when it crosses below the 21 SMA. So here we have the U.S. dollar, we see an upward movement, and here we have the cross at 10.05, cross and close below. Now the question comes up, which pair do you trade? The possibilities are the US CAD and the Euro USD. Let's take a quick look at the US CAD. And what would we expect to see? If we see this candle up on the US dollar, we would expect to see the US CAD do the same thing. We would expect to see the candle be a nice move upwards in comparison to the dollar. Well, that did not happen. If you're a candlestick person, that is, I guess you would define that as a doji. You can tell by my response I'm not much of a candlestick person. It's like reading tea leaves to me. So that's what we see when we're looking at the US CAD. So now let's look at the Euro USD. And here we see the Euro USD reacted as we would have anticipated. We've seen the Euro USD come down, which it should have as the US dollar strengthened based on that release data. Now the trade plan calls for us to reverse. So I'm going to reverse on the Euro USD. The trade plan does specify that you must wait until the US dollar confirms the move. Well, if I was purely trading the Euro USD and I was not looking at the US dollar chart, the turnaround or reversal is immediate. Great entry, but that's not what the trade plan said. If we look at the US dollar, it crossed at 10.05. So we go to 10.05, and here is where we would enter this trade. So I'll draw a line. Right, we should enter this trade at 61. Follow this up. This is at 91, the 30 pip move up. Interesting, I had a conversation with someone actually as this trade was going on. It wasn't a conversation, it was an email exchange back and forth. And they had picked up 20 pips on this. And my point on this particular trade was, here you've picked up 30 pips, and they had exited as it started to come down. There was some concern that it was going to come down and they were going to lose everything they had profited, which is a horrible feeling. You've seen a 30 pip gain, and the next thing you know, you're below where you entered and you're at a loss. So taking the 20 pip was a nice move. There are other options to this, and that is when you get into this area where you've got a 20-25 pip gain, go ahead and take half your profit, move your stop up from where you had it set up to a break even, and let it run. Now you've gained cash in your pocket or in your account. You've increased your account value. Yes, you only took 50% of your profit, but now you're in a risk-free trade. Still at this point, you would still not have been stopped out. Potential is it could go up. Worst case is it comes down and you're in that second part of the trade at no gain or no loss. Depending on your philosophy and your risk aversion and how you like to treat your particular trades, it's a nice strategy. I've used that strategy a few times in the past. I've taken my profit at a 50%, or at a 50% of my profit at a 20, 25, 30 pip gain, moving my stop to a break even, and let the trade run. Again, and set it and forget it. Set a take profit 20, 30, 40 pips up, or at least set alerts to ring on your phone, your smartphone, or send you emails. Say, you know, you're up 10 pips, you're up 20 pips, you're up 40 pips. Allows you to then get back on your computer and react to the trade and manage it. Hopefully you enjoyed this one. Talk to you soon.